Hello, everybody. Welcome to this month's edition of DeSimone Deals, the Exit Strategy Podcast. This is where we create an educational forum and platform for business owners to plan for their ultimate transition or exit. This is not a commercial to use Catapult Advisor Group. It is to make sure that our business owners out there are ready to maximize their outcome and to remind them if you're not going to use me or any of my guests, please use someone. Do not do it alone. It's a team sport out there. Make sure
Mm.
you have the right team of experts. This month's guest, we have Dave Sterrett. He's the principal of Legal Deal Makers.
Yep.
And I'm interested in talking to him because I am on the sell side. I help people sell their businesses. Dave is typically on the buy side. He's
Right.
an attorney that represents people acquiring businesses. So we're going to go back and forth today and learn why he asks for stuff that frustrates me and why my clients ask for stuff that frustrates him. And
Right.
hopefully we get to understand each other better and figure out how to get better deals because of it. Um,
Awesome.
David, why don't you introduce yourself a little bit more than I gave
Sure.
so that people understand how you work and what you do and
Yeah.
who your clients are?
Great. Yeah. Well, thanks for having me on. Really appreciate it. And yeah, we're a small boutique M&A, mostly buy side firm. Mostly sub $10 million deals, like SBA type deals. Average deal size is around 2.5 million, and we closed 32 deals last year. We've already closed 27 this year. So we're just there to move these things on efficiently and hopefully cost effectively as well. And if we can work closely with the broker and the seller and seller's counsel, it is so much smoother. So I'm really excited we're talking about this.
Great.
Yeah.
So let's just jump into it.
Yeah.
When you take on a client, a buyer, and he's looking to acquire companies, how do you prep them for that process? What do you tell them the things they need to start thinking about before the
Yeah.
process even starts?
Yeah, no, great question. I will say, I think the most important thing from the buy side, and this probably is also very annoying for the seller, is financials, right? I mean, we tell our clients that their quality of earnings report or proof of cash report is going to be the most important, diligence they can do. I know it's a lot of paperwork to request from the sellers. But if you think about it from the buyer's perspective, they are flying blind on this. They mostly have a sim, is all they have.
And a SIM is
Um,
just so people
oh,
know.
sorry, confidential information memorandum.
Cool.
Sorry
Go ahead.
about that. Some of them, as you know, Greg, are like better than others. Some of them are pretty light. And so they just want to confirm what has they've been told. And I know that can seem unreasonable, but I think if you were in that buyer seat, you'd want to do the same thing.
Mhm.
Um, so we always say quality of earnings first, go get it done, spend, what you need to spend to have someone good, because that's where I think the major problems are. I don't know. Would you agree that's kind of like maybe even the most important diligence?
Absolutely.
Yeah.
For a certain size, definitely quality of earnings you need to do and spend the money because I'm going to jump on your side of the table. Like I tell my clients all the time, this isn't like buying an item off the rack at the store. If you don't like it, you can't bring it back and say, I don't like it, can I have my money back?
Right,
Um,
right. We've
it's
had people ask. I say, nope.
it and unlike a public company that you see this when you buy stock on the stock market or you're buying through mutual funds with your advisor, there's all kinds of documentation and filings that say what this company's about, and then that someone has reviewed it and says this is true and accurate, even though there have been some cases where there's that wasn't true, the case like
Right,
Enron.
right.
But for the
Sure,
most
sure.
part, you
Yeah,
can rely on those financials. When you're buying a private company, you some my clients sometimes don't even tell their CPA all the stuff they're doing because they're hiding stuff.
yeah.
So
Right.
and the buyers know this, so they need to get their arms around it because they only have one chance to get this right. And I tell
Right.
my clients, you only have one chance to get this right.
You
The buyer
do.
only has one chance to get this transaction right. So yeah, I do
Yeah.
think that's the most important transaction. And if it's a smaller deal, I agree with you. A good proof of cash
Yeah.
is working. Do you want to explain to people what a proof of cash is versus a quality of earnings?
Yeah. And I'm, not I
I
may,
know you're not the finance guy, but
yeah, I'm not a finance guy, but my understanding, and you please correct me too, Greg, is proof of cash is truing up bank statements with say like the QuickBooks entries or like the account, bookkeeping entries, whereas the quality of earnings is much more in depth, like bringing in the tax returns and doing a much deeper
Mhm.
financial analysis. And I've just shown that I'm not an expert on this, but is that your understanding,
Yeah,
Greg?
I
Yeah.
would say, yeah, I would say quality of earnings is more, it's not an audit, but it's probably a little bit more detailed than an audit, but it's
Mm,
more like, okay, did you cut off your books correctly? Like, are the invoices in the right spot? Do the invoices
mm,
match? Do the revenues and the expenses match up correctly?
mm.
Um, if there's technical accounting issues, did you spread them over the proper period? Are you putting them
I see.
in
Right.
the
Good
right
point.
period?
Yeah.
And the
Hmm.
reason that becomes important is a lot of buyers want updates as they go through the process. So rather than say, okay, what was your quarter to date, they would say, what is your last 12 months? Or what's your rolling 12
Right.
months look like? So they want
Right.
to understand those cutoffs. For some smaller businesses, which you probably have those tweeners at an average of 2.5 million, you probably
Yeah.
have some that doesn't make sense to do quality of earnings, but some
Right.
do you do proof of cash? And proof of cash I like because I used to do proof of cash when I was in corporate, when we were buying smaller companies. And it's basically you take the bank statements and say how
Yep.
much cash came into the business,
Yep.
how much cash went out, and then you reconcile the cash from the bank statements to the P&L. And like, okay, how much
Yep.
cash came in? How much showed up as revenue? And
Right.
there's a
Right. Right.
difference. You figure out where did it go? Was it um, some other type of cash inflow? Was it a rebate? Was it
Hmm.
I don't know, whatever. And if it's on the cash outflow, you say, okay, how much went through to inventory? How much went through payroll? How much went through regular miscellaneous overhead expenses? It's okay, I
Yep.
got pretty close. Because if everything on the P&L ties to the bank statement, you know the cash ultimately got there, and that you know whether that you know the cash that you're getting, the cash flow that you're making your assessment on is true. I
Yeah.
mean, they may be in the wrong line.
Right.
It might
Right.
be
Right.
cost of goods sold versus overhead and vice versa. It might be in May instead of July, but for the
Mm.
year, you
I
know
see.
that it showed up. And for
Yep.
smaller businesses, knowing that the cash is true is
Right.
important.
Absolutely. No, no, absolutely. And that gets to another point. And actually, this will be like a good topic, especially on LOIs. I think probably one of the most important things in the LOI relates to this is working capital and the working capital peg.
Yes.
And I don't know if you feel like this, but like every deal, I feel like this is confusing, and it could be done better.
Yep.
Um,
Well, why don't you
and
explain the working capital peg for
yeah,
people and why it's important to your buyer?
yeah. So the buyers, and I think that the sellers, and don't necessarily get this,
They
and
don't.
they don't, and the buyers may be also coming at it the wrong way. I think so. A lot of them were like young, people in like private equity firms and things like that. And they do these large deals, and there's always a certain amount of working capital transferred to the buyer in these larger private equity 50 million, 100 million, whatever, $1 billion deals. You're buying an amount of basically net AR or sort of future revenue with that purchase price. So the buyers come in and they assume they will be getting something similar when they buy a $3 million plumbing company. That assumption may be just completely wrong. Like but they are definitely thinking that.
Mhm.
And I think one thing they don't necessarily realize because they never run a small business is like the cash issues. Like, okay, if the seller's taking all the AR, how are you going to make payroll in week two?
Right.
Um, and so they then assume, well, I need something to make payroll in week two. And so I should get that in the purchase price. Like the valuation includes that amount. Quite often, I think sellers do not understand or agree with that. And I feel like this is one of the biggest areas.
Yeah, I think at your end of the market, there's a lot of it's like on the cusp where some people say, well, I want a purchase price plus I get the working capital, and but
Yeah.
as you get past like at the higher end of your range,
Yeah.
I it's absolutely working capital is included in the valuation.
Yeah.
And I typically think any transaction working capital should be included in transaction. And and just so that people understand what we
Yeah.
define as working capital. And working capital in a transaction is not the same as what you learned in accounting class, where it's current liability assets versus current liabilities. In a transaction, it excludes cash.
Excludes cash, exactly. Right.
Because
Yeah.
the cat you as a seller, the cash is yours, and but also the debt you've incurred is yours.
Right.
Um,
Right. Debt free, cash free.
so it's
Yeah. Yeah.
kept debt free, cash free. But the to David's point, the buyer needs to pay payroll and pay for inventory or other expenses day one. And
Right.
if you take all the if you get paid for all the inventory and you get paid for all the AR, they then have to go get money somewhere else
Exactly.
to cover that working capital. So I've seen people say, "Well, I've asked for it and got it." And what I've told them is, you may have asked for it and got it, but
Yeah.
your valuation was lower. I said, "No."
Right.
I said, your valuation might be a 3 or 4x
Right.
for if it includes working capital. But if you exclude the working capital, it might be a 2 or 3x plus the
Yeah.
working capital. So
Right.
people have the you're when someone's running a business, you need cash, and you need air, and you need inventory in order to fund your ongoing expenses. So does the buyer. If they
Right.
have to fund it themselves because you're taking it, they have to
Right.
reduce the purchase price of the
Exactly. Yeah. Yeah. It's like wrapped in. How, and I'll ask you this because quite often our buyers like to say working capital peg to be determined after financial due diligence. What do they call a normalized level of working capital?
Right.
I find that's not specific enough. What do you like to see on the sell side, like in terms of like a specificity for that?
I I like to have the target set at the time we get the IOI or slash LOI
Mm-hmm.
defined.
Mm-hmm.
And the reason I like that is like because this is buyers think that the seller's trying to play something funky with the numbers and keep as much money as they can by
Right.
playing with that. Sellers think, oh, I can do all I can do this and get money back. And I try to tell people, if you do this right, it's when you agree to the purchase price, this is how much working capital that you need to run this business.
Right.
And theoretically, it's either you're gonna collect it and it's gonna show up in cash. If you invoice and it doesn't, you're gonna have more. If you let's say you targeted 100,000 of AR and 50,000 of AP, and let's say there's no inventory, so you have fifty
Yeah.
thousand dollar working capital.
Right. Right.
That's
Right.
low for my deals, but it's easy for the math.
Yeah. Yeah.
Um,
Yeah.
so you say, okay, you need to have $50,000 of working capital to run this business.
Right.
Um, it's really easy now. If you say, "Hey, I'm going to invoice a lot of invoices this next 90 days during diligence," that's not
Right.
fair. I should get credit for that. I'm like, well, you are
Yeah.
because you
It's
said
in
you
the
only need 50,000
right.
of net working capital. And if your net working capital grows to 100, well, you get that 50.
Get the difference. Yeah.
Yeah,
Good point.
yeah.
Yeah. Good
Now,
point.
if you collect all your AR and don't invoice anyone over the next, and then you pay off all your AP, and now you have no working capital.
Yeah.
No, well, you owe the seller, excuse me, the buyer 50K
Yeah.
because that's what it normally takes to run it.
Right.
I think where people where the issue becomes is when the company's growing or the
Yeah.
company's seasonal, and it's okay
Mhm.
when we agree on a number.
Right.
Say it's like I did one a landscaping distribution company.
Yeah.
They are flush from April through October, but from November to March,
Yeah.
there's no AR because they're not selling to any landscapers, and
Right.
there's no AP because they're not buying. But they do have inventory that's rolled over. So you have to.
Right. Right. Right.
So they may have working capital like in July of like 2 million and have working capital of like 250,000 in January. And so you
Right.
may
Of
you
course.
may agree to a purchase price
Yeah.
closer to that January time frame and a working
Right.
capital peg. So
Yeah.
that's the only time where you kind of have to think about other ways to set the peg
Mm-hmm.
or target.
Um,
When I say peg, it's just another word for target.
Target. Yeah, the target. I mean, we often do sort of the trailing 12-month average.
Yep.
Is that what you like to see? And does that seem like fair to you? Like,
I've seen 12 is kind of standard, then you decide are there other reasons to change. So I start
yeah,
with that. And so if it's growing, and a buyer would typically ask for this, if it's growing, it's like, well, wait a second, growing companies need more working capital.
Right, right.
Like, so your 12-month average is 100,000, but in your last quarter, when you've been growing at 20%, you're really at 150,000.
Yeah, yeah.
So we'll make those kind of adjustments. Obviously, I'll try to get it lower versus higher, but you're going to try to get it higher versus lower. But that's
Right.
where the negotiation comes and determine what's fair and reasonable.
Yeah.
Um, I've also seen seasonality where like, okay, we know we're going to close in the first quarter, so we're going
Right.
to set what's been the average in the first quarter for the last two
Hmm.
years.
Yeah, yeah.
And I've done other ones where not as often, but I've done it where what's the industry benchmark
Yeah.
for working capital and say, okay, it's X amount of days or it's X percentage of revenue. Um, and we'll peg it to the industry. And so like if you've been running it leaner or you've been running it fat,
Yeah.
you don't get penalized either way. You say this is what a standard an average company industry gets.
Mm.
I've seen that where we can't really get anywhere, but it usually starts with 12 months. Then we look at trailing three if it's growing, or we might look at an average for a period of time if it's seasonality.
Hmm. Do you, and I apologize because I haven't seen your Sims. Do you even just break that out in your Sims just to like make it clear like what would be included to make it simpler or no? No.
Um, I do not break it out that simply. I will tell you, you might not like my Sims. I am a minimalist. I give enough information for people
Yeah.
to make a determination of how much they think a business is worth.
Yep.
But I also do it in two steps. I don't go right to LOI. I said I want an indication of interest. Say, how much do
Yep.
you, this is using a data analogy, how much do you like me? And if
Yeah.
you
Yeah.
like me, we'll continue to talk and have dates.
Yep. Yep.
If where I like it, we decide to have continue to talk, have dates. The goal was to get to an engagement ring, the LOI.
Right.
During that IOI to LOI space, I will give monthly financial information. We'll have more discussions on what's baked into the financial. We'll look at the seasonality of the
Hmm.
monthly revenues so that you can get a good number. Because my goal is in the LOI, I want everything as locked and loaded as possible that won't change during diligence.
Me too. Yeah. Me
But
too.
before IOI, I'm like, we're dating. I'm like, I used this example before.
Yeah.
I wear a CPAP machine and I wear mouth guards. Like, so I'm a real
Yeah.
treat.
Yeah.
If I'm going on a date and I meet someone for the first time, I'm not telling them that my first date. But if we're about to get engaged, they probably know that, or I'm going to have to tell them so that it's not a surprise. But
Right.
at that point, I'm like, they really like me. I could tell them a lot more, and they're not going to get scared off. But if I
Yeah.
told them that the very first date, they
Right.
might get scared off. So I kind of do it that way.
You don't put that in the dating profile, like yeah,
No,
yeah,
no, no. Anything, yeah, like anything that may scare you off in the first day, I will
you hold back.
keep it. Although there is one exception. If there is something that I know will scare a buyer off, and
Yeah,
it's a legitimately good reason to be scared, that you have
yeah,
to have a certain mind. Like for example, if you have a significant customer risk or a concentration risk or a
yeah,
vendor concentration risk, or it's a geographical
yeah.
concentration, and I know that people will not buy if there's that there, I will
Mhm.
put that in the book right away and say,
Call it out.
I
Yeah,
said, some people don't care, some people do. If you do care, I want you to know now so we don't waste any
yeah.
time.
I think that's great. I mean, it really it saves everybody so much time, because
Yeah,
there will be a buyer who can work around that, but
yeah,
otherwise they'll go on several dates, and then they find out and they're going to blow it up.
right. Well, it's like if you're dating and sitting there saying, like, I love going to sporting events. And that person goes, I hate going to sporting events, but I love going to concerts or I like going on
Right?
hikes. I'm like, well,
Yeah.
I don't. The worst thing in the world for me is to go on a hike. Well,
Right.
like if that's what all you do for fun is going hikes, I'm like, well, let me know now. Like, we're not probably not going to get along.
No,
You
no,
don't
no,
like
no.
going to sporting events, you don't like playing
Yeah,
golf. Like you
yeah.
should know right away because I'm
Right.
going to do those things.
Exactly. No, no, no. I think that's a great way to look at it. Like you're trying to find a good fit, and
Correct.
on both sides, right? And it's more than just money, and it's a fit, and it's like you said, it's a seller's legacy, employees,
Hmm.
vendors, clients. They want someone who's going to take care of all those folks. And the buyer obviously wants to be successful. I mean, let me tell you something that drives me crazy on the seller side, and then this just happened recently. We're a year into a deal, Greg. It's been off and on. And actually, an attorney just got involved for the first time. And he comes back on the purchase agreement, and it's like a $3 million deal. He's like, "Oh, we want 170 or $150,000, sort of earnest money or deposit right now. We're a couple of weeks from closing, And he said, I want to make sure the buyer's serious. And I say, my guy's been on this deal for a year. He spent tens of thousands of dollars. He's moving his family across the country. What? Why do you think he's not serious? Like, I don't know. What's your thought on deposits? Because it feels rinky dink to me. It feels kind of like we're
I have
adults.
very rarely. I've only actually had a deposit on one transaction. It was
Yeah.
actually one of the more recent ones, and
Yeah.
I didn't ask for it.
Okay.
It was put into the
Right.
LOI, and I'm like, okay.
Yeah. Yeah. That's helpful to hear.
If you want to
Yeah.
put it in there, okay. And it was refundable. Like I'm like,
Yeah.
fine. But my feeling is either I try to vet if they're serious or not
Right.
earlier on through conversation, and you can tell by the types of questions they're asking.
Yep.
You can tell by how forthcoming they are, like about where their funding is coming from. If they have the source of funds, they can prove it earlier than later. Uh,
Yep.
Deposits, to me, particularly if they're fully refundable, like
What's the point? Yeah.
yeah.
That,
But
that's my view too. Yeah. I mean, I almost never see them. I mean, and it just
no,
feels,
I think it's a legacy and it's older at the very low end of the market. As you get big and like I think like a $2 million transaction, you're probably looking at people with anywhere from 300,000 to like 600,000 of earnings. So
yeah.
it's less of a reason for that. And the buyers will have to come up with more. They typically are gonna have to come up with a significant amount of cash to put down to qualify for down payment. So
Definitely.
if you can prove you have the down payment and it's there,
Right.
I think that gets you that gets you more comfortable. You
Right.
mentioned earlier dealing with people that are from private equity and they look at all these different things, which tells me you probably deal with a lot of people what we call searchers.
Searchers. Yes.
So why don't we talk about searchers and what they're looking for, and let's talk about the other types of buyers that you represent and how their perspectives on what they're looking for may change.
Yeah, no, it's a great point. And we are like very heavily in the searcher, world. So it is a lot of these young MBAs, a few years in high finance. Um, so, I mean, I think first of all, they're numbers folks, I mean, that's really their background generally. And so the spreadsheets they build on these things, it's incredible. I think they could win a spreadsheet competition hands down again, across
Yes.
the country. Um, so I think that's their sort of number one thing. A lot of them are industry agnostic. They also are very confident. I think you probably could, agree. They are very confident and they
Well,
feel like they could be a success in any industry. Which I question. I feel uncomfortable a lot of times when they're going into something that seems very unique.
mhm.
Um, but they are impressive. And a lot of them have done very very well. And I think just age and inexperience alone should not be like a total deal breaker.
Mhm.
Um, they can be a little egotistical, and I know that could be difficult sometimes and demanding. you know
I deal with all of the buyers I deal with, whether it's a searcher, an independent sponsor, private equity, strategic
Yeah,
CEO of a strategic company. They all got to a certain point because they've been pretty good at what they've done, and
right,
there's always some level of ego.
right.
Some are easy to deal with, and some are not.
Yeah, yeah, I think that's right. I mean, I think just personally, I do feel like the strategic buyers and the buyers, even if they're searchers, sort of self-funded searchers with experience in the area, it makes the most sense and is generally the best fit. But I've seen it work. I've seen it work in fields where they really have never worked before.
So when you're dealing with a searcher versus, say, a guy that's leaving corporate and says, okay, I don't want to retire. I want to buy a company now. I want to be
Yeah,
an entrepreneur now. So then
right.
they don't have the same mindset as say a searcher. How do they approach a transaction differently in your mind?
Yeah, I think, and I, kind of getting older, I think I appreciate this more. That life experience is really helpful. I think the more experienced person does not sweat the small stuff or like overly focus on minutia. I find the younger folks get into every last detail of like say purchase agreements or even LOIs. Sometimes they ask you like we're on a 12th version of the purchase agreement just with them before we've even gotten it to you and the sellers council.
Hmm.
And I'm like, guys, like you got to move quick. This is
Yes.
business, focus on a few key things. I don't think the older, more experienced people do that. They know what's important. They know what to focus on, and I really appreciate that. Um,
Like I don't deal with the entrepreneur, like the retiring executive that wants to be an entrepreneur all of a sudden. I have come across search searchers.
yeah,
Uh, what I see, two things. One is definitely they're craving information.
yeah,
There's never enough information to make a decision, and
that's
if
right.
there's more information, they will wait till they get it before they make a decision,
Yeah, yeah, yeah,
which
totally.
isn't always possible in a process. Like
No,
I tell people that if you're easy to deal with, you're probably going to get further along in the deal. That doesn't mean roll over and don't ask for the right stuff.
of course. Yeah, 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 yeah.
But to your point, like knowing what to ask for, what's going to move the needle, and what's just information is
Right.
important. The other
Yeah,
the other thing, and tell me if you see this, and this is where I think searches, at least when deals that I'm running, I like them and I'm impressed by a lot of their insights. But where they tend to lose out in the transactions I deal with, well, one is if they're competing with a private equity firm, they don't have the capital
right.
to
They don't
go.
have as much cash. Yeah, I agree.
But
Yeah,
the other part is they they're much more risk adverse. I mean, everyone has to have
yeah,
you have to have some kind of risk
I
tolerance.
agree.
Like there's no foolproof in acquisition or investment.
Right, exactly.
Uh,
Yeah,
and what I find, and you tell me if you see this, I found like their initial offers are typically overly structured where they want more in earnout than a normal buyer would have. They want
yeah,
more in seller's equity. They want some
yeah.
of them to retain ownership, seller's notes, excuse me. They want to retain. So they
Right.
not just like sometimes like a project will have one or part of one or two.
Exactly.
Well, the
Don't
search
have
is like they put
three.
all of it
Yeah,
in there, and I'm sitting there going, my client is giving up control, but
yeah,
keeping all the risk. And I'm like,
yeah.
at some point, it's like, it doesn't make sense to sell it if they gotta give you all
Right.
the benefits and they can keep all the risk.
No, I agree. I see this a lot, and I'm like, guys, you got to just make a move. I almost equate it to have some friends or people I know who consider themselves real estate investors, but they just go around and like lowball offers on houses at like half the listing price. And it's like, oh,
Yeah,
I know this is safe. It's like, yeah, of course, like anybody could make money on that, but like no one's going to sell to you at that.
right.
So it's like they're looking for the perfect deal, and it's kind of like it's going to be messy. Get it pretty good and then figure it out. And that's what I think business people, like people that have been in business for a while, get.
Right.
um there's a
Yeah.
lot of uncertainty here. I'm like, we're thinking of doing something, post or something where we say we're not going to get your risk to 0%, but we're going to
Right.
hopefully get it down to like 85 maybe, and then the 15% risk. I mean, that's great.
Right. Well, if you
Yeah.
want to return, you have to take risk. I mean,
Right.
if
Right.
it's risk free, you get 1%, 0%.
Yeah, exactly. You can put it in a savings account. Yeah,
The risk,
exactly.
the more risk you take on, the better the return, the better price you're expected to get to make it worth your
Right.
while. Um,
Yeah.
we didn't talk about this, but it comes up a lot. And get your perspective.
Yeah.
I talk to my clients all the time, and their CPAs will say it has to be a stock deal for tax purposes.
Mm.
And I sit there and say, well, I understand why you want it to be a stock deal.
Yeah.
Here's why the other side might want it to be an asset deal.
Right. Right.
When you're evaluating a stock versus asset deal for your
Yeah.
clients, what is the thought process that you're going through to decide what's the right fit for a particular transaction?
It's a great question. I mean, I think so. They've all listened to the podcasts. They've definitely listened to DeSimone on deals.
And I doubt that, but hopefully.
I doubt that. Acquiring minds, I think, is the big one for the searchers. Um, and they're just fed asset purchase, asset purchase, asset purchase all day long. Mostly the only thing they know is the liability aspect, right? Like you leave the liabilities behind in the old company. I am shocked that they know nothing about the tax implications of how to structure the deal.
Hmm.
And other than working capital, I think the tax structure is the most important because it's a
Right,
lot of money.
right.
So they don't know that they can depreciate the assets in an asset purchase based on, the different
So
schedules.
explain what that means to someone.
Yeah. So, and not to get like too much into the weeds on this,
Yeah,
but
real simple.
yeah, real simple. Basically, you can deduct the cost of the assets if you do an asset purchase. Like you get a tax savings on that. So just to make it
So
simple,
say I have
you know,
assets that are 100 that I bought for 100,000, I've depreciated, they're on my books for zero. If I do an
right.
asset deal, what can the buyer do now?
Yeah, the buyer, like, let's just say it's a 10-year, depreciation schedule. Every year you get to take a $10,000 tax deduction, basically.
Right.
So it's free money. It's a free tax break, which is really nice, and it adds up over time. We tell our clients to model the tax implications of their deals. They almost never do. Like it's not in there. They do all the fancy calculations, but never look at it.
Wow,
Um,
that's
it's
surprising.
amazing.
That is
Yeah,
surprising.
it's amazing to me. I don't even know. So we say to them, okay, yes, for you, asset purchase would be, of course, the ideal. No liability, and depreciation. Obviously, we then say for the sellers, stock sales better from a tax perspective, right? Capital gains tax rates versus ordinary income tax rates.
Yeah.
And then we also mentioned, though, in certain stock sales, right, the 338H10, 336E tax elections you can do to like turn it into an
So
asset
legally
purchase.
it's one, but for taxes it's the other, so you can get the best of both worlds.
Exactly. So you get exactly. So from like legally, you're buying the stock of the company, but you can just appreciate the assets. So there are these little tax tricks, but I'm shocked that it's like not the first thing every searcher is thinking about, but it's like the last thing they're
So
thinking about.
why is there occasions where a buyer, searcher would want a stock deal? I can think of a few, but
Yeah,
why would a buyer want a stock deal, even though the liabilities will come forward with them?
yeah, great question. Like I think the probably one of the number one reasons is when there are like so many pieces to the business that are really not transferable. So like we're doing a property management company deal now, and all the property management agreements, and then all the leases, like the underlying leases for the tenants and the landlords, um, are not assignable. And actually the leases are with the property management company. It's like hundreds of these
When
things.
it's not assignable, that means what?
It means that if you were doing an asset purchase, you couldn't take over, you wouldn't get the right to those contracts, basically. And so in certain deals, the whole deal is the contracts. So if they don't assign, you have got nothing. So quite often then you need to do a stock
So,
purchase.
yeah, and that's what I've seen is where either the contracts can't be assigned or the mechanics of they can be assigned and transferred, but with approval.
With approval. Yeah,
Process of
exactly.
going through, like, say you have like
Uh,
300 contracts on,
uh,
we to go and get 300 approvals.
right, exactly.
Um,
Never.
yeah,
Government contracts too. You got
yeah.
business with government contracts, those have to be rebid, if you do an asset purchase. So,
So,
that's yeah.
so if you have a stock deal, then, um, now, so like an asset deal, you like, and I'll do a quick little story for someone so that you can follow on the conversation. On an asset deal, let's imagine Dave has a company and I have a company.
Yeah.
My company, I'm selling it. I have a box. All my
Yep.
assets are in it. So my customers, my
Yep.
inventory, my AR, everything's in my box. And
Yeah.
Dave says, I want an asset deal, and I'm going to buy all your assets. I'm going to buy your inventory, your stock, your customer list, your
Yep.
website, domain name, and all that stuff. Here, I'm going to give you a check. And I take the stuff out of my box and he puts it into his box.
I
My
love it.
box
That's a
is
great
still
structure.
there.
Yeah.
There's just nothing in it other than what I owe people. and
Right.
I'm going to pay them off with the cash you just gave me.
Yep. That's great. Yeah.
On a stock deal, the top of each of our boxes has a ticket that says, or a certificate that says, Greg DeSimone owns this box.
Yep.
David David Sterrett owns this box.
Yeah.
So instead of like he said, okay, I have all these contracts that
Yeah.
are liabilities, but they're also assets.
Right. Right. Exactly.
And
Yeah.
he
Yeah.
says, I don't want to have to go talk to 300 people to get all those contracts. So I'm
Right.
gonna buy the stock. You're gonna send me that certificate so that I own everything in your box.
Right. Just go buy the
So
box. Exactly. Yeah.
so the company, I no longer own that company. It is now David's company,
Yep.
and I own nothing. Before, if I had an asset deal, I still own the box even though there's nothing in it,
Right.
but I still own it.
You still own it.
Um,
Exactly. Yeah. Yeah.
so
Yeah.
now if you do a stock deal,
Yeah.
so you now own the box and you own all the liabilities that relate to it.
Yeah.
What do you do differently when you're drafting an agreement to protect the buyer in that situation?
Yeah, that's a really good question. Much deeper level of due diligence, because you are like taking on those liabilities. So we generally always do like litigation searches, bankruptcy searches, tax liens, UCC liens, all those kind of things. We also put in much stricter reps like representations and warranties, like language in the stock purchase agreement.
Explain what a rep and a warranty does for the buyer and seller.
Yeah, it's basically like a promise. So, for example, we'll ask that a seller sign off on the promise that they are not being sued at the time, that the purchase is going on, that they don't even know of any threat of a lawsuit, for example, that they're not under any government investigation, or that there's no government orders, against them, no tax problems. We're asking for all of these promises because then if they're going to put their name to that and sign these promises, they're on the hook for that if they're lying, post close.
Mhm.
And obviously we put teeth in, to try to catch them if
So
they're
when you
lying.
say put teeth in there, or they're maybe lying, or they're mistaken, or let's say they misstated
Right,
versus lie,
right.
but there are people who have lied.
Yeah.
So you want to put teeth into it. What does putting teeth into it mean?
So it's really about money. I like a way to claw back money, basically, because if some of these promises aren't true, you shouldn't have paid what you paid, right? You're gonna have like some like extra cost or like lower revenue. For example, like, oh, we these are all our major customers, or they have been for 2 years. You know, if that's not true, then suddenly, you shouldn't have paid X for the company. So I like the forgivable seller note, for
Okay.
example, you know, where okay, well, if you lied on a bunch of these promises, and were harmed, we're gonna pay you less money on the loan you gave us. It's an easy way to like enforce the promise,
So
I
that's
think.
like, I sometimes have used with my clients the word indemnification, means they're going to indemnify for making a mistake.
Sure.
So, which is a fancy term for putting teeth into it,
Yeah.
which I like.
Yeah.
So I like the idea of the forgivable seller's note, but uh, what are some other ones? Like, have you do you use escrow on top of this forgivable
We
note?
try.
Are there other
Yeah.
mechanisms you use to cover that?
Yeah. No, great question. I mean, I don't know. It'd be interesting to get your thoughts too. Escrow is a great idea, like holding back money for a year, for example. Like, let's say it's a $2 million deal, you hold back $200,000 for a year in like an attorney's trust account to make sure like nothing bad happens. The buyers would love that, and they ask for that a lot and almost never get it. Like, I mean, it just does not seem sort of standard
Hmm.
anymore. um so we ask for it but generally don't get it. There is indemnification, like you said, which is basically, hey, if the buyer gets sued for something that's the seller's fault, the seller is supposed to defend them in court. It's okay, like you got to put that in there, it's important, but enforcing it is challenging, right? Like if the seller doesn't want to do that, you have to sue them to force them to defend you in court. That's its own lawsuit. So that's why I like, the seller notes and forgivable seller notes the best. Because in reality, too, like if you get sued by the IRS because of something the seller did, you're not going to pay the seller note anyway.
Right.
So it's sort of like
Yeah,
just
you're gonna fight over it, and that's the only
yeah,
leverage you have is not to pay it.
exactly.
Versus making it
So
a mechanism that you've agreed to. Then that's kind of what I've told my clients. Tell me if I'm correct on this. The reps and warranties is like you're saying my business is perfect except for this, and this.
right,
And if I say is not true, this is how I'm going to reimburse you for the cost of that mistake, for
yeah,
that mistake.
exactly. That's right. That's right.
Um,
Yeah,
so and then the escrow or the forgivable note is just a way to make sure there's money
yeah,
to cover it so that you don't have to sue each other and pay for additional litigation. Not that we don't want to
right.
pay lawyers, but you don't want to pay for litigation when you could have said,
Yeah,
if this happens, we know it could happen. We hope
right.
it doesn't, but
Yeah.
if it does, this is how we're going to handle it.
That's it. And I mean, the thing is too, like from a buyer standpoint, chasing money, chasing a seller for money, good luck, right? Like
Right.
it's a long and arduous process. This way, it's just like, hey, I've got an easy way to settle up. I'm just going to pay you less on this. And I don't know. Do sellers sort of understand like seller notes are gravy in my view? If you get it, that's wonderful,
Hmm.
but you might not. I mean, the business might not work out. And they're like, but I'm owed this money. Well, guess what? The business failed. Like, you're not getting it. I don't know if,
Yeah, well, I try to make as much of the deal whenever possible, cash at close.
of course. Yeah, yeah.
If there has to be structure, and sometimes there has to be,
Sure.
because there's risks that need to be mitigated, or there's enough upside in the future that you may want to participate in that.
Yeah, yeah.
Meaning, I set this business up and the revenues are going to double in the next year. I'm like, well, I want to get paid for it. I'm like, well, until I see it, I don't believe it. So yeah, you might have an earnout to get that,
Right.
or you may say, I know that you're going to be able to sell this in 3 years. So, and you're gonna make a ton of money. And I've laid the foundation. You're gonna have to
Right.
do some more work to get it worth it. But you couldn't do without my foundation. I wanted a little bit of the second bite too.
Upside.
So,
Yeah. I want to talk about this actually. Yeah.
so I've seen that.
Yeah.
But here's what. So I have a different question to follow up with him. But so
Okay.
what do you want to follow up on
I
the
want to talk
side?
equity role from the seller side, but let's talk about your thing first. Yeah, yeah, yeah.
One of the things I like going back to the very initial comment I made was like having CPAs tell my clients, you have to have an asset deal.
Yeah, yeah,
Because
yeah.
of the and I what and tell me if I go back, tell me how your clients or buyers would look at this, because this is how I try to approach it. I said,
Yeah.
you don't have to have an asset deal or a stock deal. You just need to know what the impact is.
Right.
If you have
Yeah,
an
yeah.
asset deal, I'm gonna like just make round numbers. You have a $5 million deal. After everything, you're gonna net 3 million after
Right, right,
taxes
right. Yeah.
on an asset deal. On a stock deal, you're going to net 3.5. And those are random numbers. There's no
Yeah.
basis on it other than I picked it. But generally,
Yeah.
um, you're going to net less on a asset deal than a
That's it.
stock
Sure,
deal
sure.
in
Yeah.
general.
Generally.
So there's a $500,000 difference. If
Right.
I sell you a stock deal versus an asset deal, if I sell you an asset deal, I'm gonna get 500 less,
Yep.
thousand less than a stock deal. How would your buyers think like, hey, I will do the asset deal. I understand why you do the asset deal, but
Yeah.
it's gonna cost me $500,000 just by picking the structure that works for you. Can we talk about how to bridge that gap? How
I
would your
think,
buyers look at that kind of a conversation?
well, I think it should, it's just so rare that they're, thinking about this, especially on the tax applications. I think it's a good idea. I propose it both ways. And I would say there are different prices. Why? From the buyer standpoint, because you're taking more risk,
Right.
on the stock purchase. But the seller's getting a better tax benefit, so they're getting more money. So, I think if you showed the difference and priced it in, it would be more efficient. It would make more sense. Um, and I'm surprised that any seller like proposes anything other than a stock deal, right? Because of the tax side.
Right.
Um,
They
and I
do.
mean, yeah, yeah,
That's what they want all the time.
of course, yeah, yeah, yeah. So, do you ever do both? Like, kind of price it both ways? I mean, that I don't know. That'd be kind of a novel. Yeah.
Yes.
Oh, that's great. So
I
you don't,
don't say price it. I say on the bottom line, if this is a valuation, we're going to net X amount less.
yeah, 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 yeah,
Um,
yeah.
But at times I've had talks to my clients. I'm like, I know you want an asset, you want a stock deal. You're not going to get it. And there's other times I talk to the buyers and say, I know that you want the asset deal. I said, but let me tell you about what's in here.
Right.
Let me tell you what's in my box.
Right, right, right,
It's
right.
going to be a nightmare to get it out of my box and into your box. It
Yeah,
might be easier just to buy the box.
totally.
And so think about it
Yes.
that way before you make your offer.
Well, it's interesting, right? Because from the financing side, from the buy side, like the bank will do it either way. They don't care.
Right.
So, like, yeah, I mean, it's almost like if you want to make your offer stand out as a buyer, offer a stock purchase, it's got to
Mhm.
be a 15% bump from the tax perspective, I would think, you
It
know?
depends. Like if you're, well, if it's a C corp, it's absolutely a huge impact
Yeah,
because you get the double taxation.
yeah,
If you're, for people who don't know, if you have a C corp and you think you're going to sell it and you're not going to be raising capital,
right,
change it now, so that you can get favorable tax treatment. A C corp is when you sell the company, you get the entity gets taxed on
right.
the capital gain. So you have a $5 million purchase price. The basis in the company, the assets are all, the cost is all worth. I'm saying it really simplistically. It's a little bit more
Yeah,
complicated, but it's worth 2.5 million. You're going to pay tax. Let me make it easier. You get the cost is 4 million. You
yeah,
get 5 million. There's $1 million of capital gains.
right,
Um, the company's gonna pay taxes at the corporate rate. So
right.
let's just pick it. I forget what the corporate rate is. Let's say it's 35%. So now there's
Yeah,
650,000 left of money after taxes in the company. Now the owners want that money. Well, they have to
right.
do a dividend, and
Yeah,
then the owners say that they're at a 35% tax rate.
yeah,
They pay 35% tax on the 650. So now it is like 400,000. While
yeah,
if you were an S corp or an LLC or a partnership, which is
yep,
a password C, the company does not pay taxes. That
yep,
$1 million goes right to the shareholders or the partners or the members,
yep.
and then they pay their 35% of that. So they're going to be at 650. So there's
Mhm.
basically a 35% times a 35% difference in taxes. Again,
Yeah,
very simplistic. That's not 100%
simplistic.
true.
Yeah,
Talk to
yeah,
your tax attorney
yeah, yeah,
and
yeah.
your
And your
C corp.
accountant, definitely. Not me. Yeah, no, I know enough to at least point him in the right direction. One piece about that too, which is why some buyers do want to do the stock purchase, is a QSBS or qualified small business stock.
Right.
Um, and obviously that's gotten more generous with the latest legislation,
Hmm.
last month. And it might be a way to like pitch it to the buyers, be like, hey, do a stock purchase because you can get this up to now, I think $15 million
Hmm.
capital gains tax free if you do this qualified small business stock
Right.
election.
And that's why I
Um,
think it's important for the sellers to plan on, like, when you're going to sell, it's like, okay, we'll figure out the taxes at the end. Like, no, let's
no,
figure out what all your options are so that we know what the moving parts are, and and like we said, buying a business it's about risk tolerance. How much risk are you willing to take for what amount of dollars?
right,
Certain people find some things very risky. If they think that you might be audited by the IRS, I'm like, oh, I don't want to deal with that at all. I know that what you've done is very risky and you will get audited. I'm like, they don't want to touch it. And
right,
other people are like, I've been audited before, I don't care.
right. It's like being
Um,
sued. It's sort of like,
so, but
but
your tolerances change and people
yeah,
view things differently. So understanding what your options are so that you can adjust the price and the structure to get what you need and make sure it allows you the other side to get what they need enough that they'll still write you the check.
yeah,
Uh, and that's
that's
the
right.
goal. The goal is to sell it, to get the other side to write a check and be happy, and for you to write a check and be happy, to receive a check and
Exactly.
be happy.
Yeah.
So
Yeah.
you,
And I
I
think, yeah,
go ahead. I was gonna say
I was
we're
just,
running out of time because I got
yeah,
I'm going up against the clock for another call. But
yeah.
you said you wanted to ask me something about rollover.
Yeah, equity roles. So, and the PE guys love this, second bite at the apple,
Yep.
like, oh, whatever, I'm going to buy, 90% of your shares of your
Yep.
company, Greg, and then you keep 10 and you'll get this amazing upside.
Hmm.
How do you kind of advise your clients on that?
I advise them a couple of, one, as I said, I talk to private equity firms all the time, and in general, they will tell you the multiple on invested capital or the return on that investment, they
Yeah,
look to get 3 to 5 times.
Yeah.
And so I say if you have a $5 million transaction and they want you to roll over 1 million, so you get
Yeah.
4 million in cash, and then you get a million in stock. When they go to sell your company a second time, you sold it the
Yeah.
first time, the second time's the second bite. They're hoping and planning on it to be 3 to 5 times, so $3 to $5 million. I
Yeah.
said, so that's great. It's a great return.
Yeah.
Plan, I said, it could be worth zero
Right.
because they could screw it up.
Yeah.
I said I've seen it where it was just worth it stayed to be worth the million. They never made it worth
Mm.
more. So you just waited 3, 4, 5, 6 years to get that million. So it was just deferred compensation, deferred
Right. You
payment.
never made anything on the money, but you didn't pay
Yeah.
taxes on it initially, I guess. Yeah.
Yes.
Yeah.
And then some people they get that 3 to 5, and some people, and a very few, but some get a bigger one. I said I would plan on. I said it could be zero. I would plan on you get it deferred.
Yeah.
Um, and if it's worse, you missed you swung and missed, and you got the worst of it. If it's any better than that, it's all upside. Um, but make sure that the cash you got is enough for you to be happy with the deal.
I get
If
you.
the only way to win in the deal is to for the stock to be worth 5 times 5 years from now,
Right.
and otherwise it's a bad deal for you, and
Right.
you
Don't
didn't
do
get
it.
enough money to suit your needs, then don't take the deal.
Yeah. No, it makes sense. That makes sense. Um, Thank you so much, Greg. I've learned so much. This is great.
Well,
I'm
you're
like
my
getting
guest,
there.
so thank you for coming here and
Yeah,
helping me and get the different and my the people I work with to get the a different perspective. And
absolutely.
hopefully people see that uh, it's not adversarial. Both sides
No.
are trying to accomplish something in a
Yeah.
negotiation. Well, at least this is my perspective, and sound like Dave, I think it's yours as well. The
Yeah.
goal isn't to win every section of the agreement and every part
No.
of the deal. It's to figure, is there a deal to be had? What does a good deal mean for both sides? And
Right.
can we get them to overlap? And if they can overlap and come to agreement, then we're gonna have a deal. If we can't, we'll just
Yeah.
find the next best opportunity.
100%. Absolutely. No, definitely. You don't want it to be adversarial at all. You know.
And I'll tell you, most of the people I've dealt with, it's very rarely adversarial. There are some attorneys I like better than others,
Sure.
but it's
Me
very,
too.
but it's very rarely adversarial. It's where
Yeah.
like, okay, this person's just trying to win; they're not trying to get a deal.
Right.
Most people I deal with on the other side, I know what they're trying to do, and I may not be able to get my client to agree, but they're being reasonable. They just got to protect their client's interest, and I've got to protect my client's interest. And sometimes it
Yeah.
works, and sometimes it doesn't.
I say if it's all professionals, we're all just nibbling around the edges for, little thing, small changes really, and then you get it done. By the time I get involved, I hope the deal terms are solid.
Right.
We'd rather not be involved in that.
Well, I'm getting closer to against the clock. So if people are going to see this and they say, "Hey, I
Yeah,
like his style. I like how
yeah,
I want him to represent me," how do I get
yeah.
a hold of you?
Great. Yeah, the easiest place to go is legaldealmakers.com. That's the easiest way to find us.
And guys, we're going to put that at the back of the of this podcast, so you should be able to look at the very end.
Yeah.
Um, great. So, David, thank you so much for being a guest, and hopefully we get to do this again sometime because I think there's a lot of good information you shared.
Likewise, and I look forward to working on some deals together.
Me too.
Cheers.
Thanks.
Thanks, Greg.
Bye.